Welcome, everyone. Thank you for joining us tonight as we discuss some plan giving and tax saving ideas with you. As you know, we are not your financial planner nor your estate attorneys. This is completely informational. So if you do have questions specific to your financial situation, please make sure you reach out to your financial planner or estate attorney. Today's discussion is not about tax strategies for their own sake. It's about helping you make a bigger impact with the assets you already have, while potentially improving your financial and estate planning outcomes. So by the end of this webinar, you should have a better understanding of the following: which assets may be the most effective to give, how to give in ways that maximize both charitable impact and tax efficiency, how to create a legacy that reflects your values, which plan giving tools might fit your stage of life and financial situation. We're very fortunate to have two wonderful grads with us tonight. They're members of our Plan Giving Ad Hoc Committee. We have Michael Colbert, class of 73, and Frank Giordano, class of 83. So with that, we're going to go ahead and start here. We can see a little bit about Michael and Frank, and you'll be able to look at those a little more detail. We'll send out those information about them both in an email with the recording. So now we're going to go ahead and open some questions and food for thought. So when most people think about charitable giving, they think about writing a check. But what if the most effective gift isn't cash? What if you could get more out of your giving? Many donors are surprised to learn that they can often give more than they thought possible, reduce taxes, generate income for themselves or loved ones, and leave a meaningful legacy. Today, we'll explore some of the tools that can help accomplish those goals. So keep this in mind. Start with your goals, not the gift vehicle. Before discussing any specific strategy, ask yourself about what you want your gift to accomplish and whether you have any financial needs you are trying to meet, like an ongoing income. Some questions you can ask yourself are, do I want to make an impact now? Do I want to leave a future legacy? What about supporting family members while giving? Is there a need to reduce taxes or create retirement income? Can I simplify my estate? The best giving strategy depends on your goals. Think of these planned giving tools as different tools in a toolbox. The right one depends on what you're trying to build. And so now we're going to go ahead and start with Frank as he talks about donor advised funds and some other giving opportunities. Thank you, Frank.
Great. Good evening, everyone. And thank you, Laura. Thank you, Vicki. And I want to thank everyone on the call tonight for spending a little time with us this evening. For the next few minutes, Michael and I are going to discuss planned giving and some of the vehicles to help you make the most of your charitable gifts. But before I do that, I just can't stress enough of what Vicki just mentioned earlier about starting with your goals and not with the vehicle. There's no shortage of solutions for charitable giving, but I really do think that if you begin by asking yourself, why am I giving or what am I trying to accomplish, the solutions will sort themselves out. So speaking of solutions, the first one that I'm going to talk about is donor advised funds, or DAF. We got a lot of questions earlier about donor advised funds, so I'll hit the highlights and hopefully we'll leave a lot of room at the end for questions. A donor advised fund is one of the easiest and most flexible tools that we use in charitable planning. This fund is an outside fund that's housed with a public charity. I prefer to use the term sponsor or platform. These platforms can be very generic, like something you'd find at Fidelity, Vanguard, TD Bank. There are other providers too, like National Philanthropic Trust is a partner of ours, NPT, and they work with clients that typically have more sophisticated needs, but they can also handle the more generic accounts as well. The way the donor advised fund works is that you contribute cash, appreciated stock, or other eligible assets into an account, and then the sponsor will distribute the donations according to your wishes. The two biggest benefits that I see from a DAF, other than being very simple, are number one, the sponsor handles all the paperwork. They'll issue checks or send wires out on your behalf to the charities of your choice, and they'll keep track of the investments over the years. The second benefit is the one that most people like to take advantage of, and that is donating appreciated securities or a lump sum of cash in one calendar year for tax purposes. And then you can spread your donations out over years or decades. A good example of this is, let's say that you're in your peak earning years or you're about to retire and you're in a very high tax bracket. You can donate a lump sum of cash today or appreciated securities. You can take the full charitable deduction if you're eligible in the current tax year instead of later years in retirement when you're typically in a lower tax bracket. That cash or security will get placed in a brokerage account where it can potentially grow over the years. And then you can distribute the money as you see fit going forward. Keep in mind that the money that you contribute to the donor advised fund is irrevocable. You can vary what entities you contribute to and how much you contribute from year to year, but eventually all that money will go to charity. One other side note on a donor advised fund too is that when you put that cash into the brokerage account, very often, depending on how long you leave it in the account, that balance can grow. So if you put $25,000 in year one, thinking that you're going to give $2,500 a year for the next 10 years, you might be in a situation where that account balance actually grows. So the benefit to the charity will be greater than the initial $25,000 that you put in. You won't get an increased tax deduction because once that money gets placed in the brokerage account, that belongs to the charities. But it is a benefit for the charities if you do leave that money in over time and it grows. In our next example, we're going to talk about a strategy as opposed to a vehicle. And this is what we call using the right asset. So in keeping with the theme of what is our goal, let's say you want to contribute a lump sum in 1 year. Maybe it's a class reunion, maybe it's a capital campaign for an endowment, or it's a 50-year class giving project. The first thing that comes to mind, and it's usually the easiest solution, is to just write a check. And while that may work, it may not be the most efficient use of your capital. Sometimes using an appreciated asset, such as a stock, mutual fund shares, or other long-term investments, can be a lot more advantageous to both you and the charity. So a real-life example is, let's say your goal is to contribute $50,000 to your class reunion. And let's say you bought $10,000 worth of Apple stock years ago, and now that stock is worth $50,000. You can certainly sell the stock to raise the cash, but keep in mind, once you do that, you're now exposed to $40,000 in capital gains that you have to account for by year end. So depending on your tax bracket and the state that you live in, you may be on the hook for up to 30% or more in capital gains tax. Once you pay Uncle Sam that 30%, you now only have $38,000 in cash left to donate. So you'd have to come up with the additional $12,000 to complete your $50,000 gift, or you'd have to dial it back to $38,000. A more efficient use of that stock would be to just donate that directly to the charity. You'd still get the full credit for the $50,000 charitable deduction. It would eliminate any of your potential capital gains exposure by giving it directly to the charity, and the AOG would get the full $50,000. The key takeaway here is that while the goal is the same and the asset's the same, how you execute it can have a real significant impact on your own personal balance sheet. So with that, I'm going to turn the floor over to Michael.
Yeah, thanks, Frank. And likewise, I pass along my greetings to those on the call. The next strategy, qualified charitable distribution, QCD, is a great one for anyone age 70 and a half or older with the traditional IRA. So those of you who are approaching age 70, you might incorporate this into your future planning. But you do have to be 70 and a half exactly. It's not a tax year thing. It's a 70 years and 6 months old to do it. But the first time I did it was to avoid writing a check. Frank just talked about a couple of strategies there. And this is another one where you don't have to write a check. We had a 50-year class gift campaign recently for the class of 73. And it was nice to be able to make a multi-year commitment, probably give a little bit more than I would have had I had to write a check, and just do it directly from the IRA. So the QCD allows funds to go directly from the IRA to the charity. And by direct, we mean, there's a distribution form typically from the IRA custodian that one would fill out to to send it directly to the AOG with the West Point address and tax ID number. But it's a very tax-saving strategy, because by not taking constructive receipt, then there's no income tax on that distribution from the IRA. So that's the tax efficiency is probably the main, the main advantage, other than the ease of not having to write a check. QCDs used to be used in conjunction with RMDs back when the RMD tax laws said 70 and a half was the magic age for RMDs. But now, for those of you age 73 and over, you can certainly satisfy required minimum distributions by using QCDs as well. So again, keeping the distribution out of taxable income, which is important not only for the immediate tax, but secondly, sometimes Medicare premium surcharges kick in at a certain income level. I think this year it's, for married filing jointly, $218,000. So if people are getting close to that, then again, it's just a second advantage to keep the Medicare premiums at the lower level. So it's an excellent strategy. Again, it makes sense if you're required to, if you're age 73, required to move the money and take an RMD, then, again, a QCD allows that money to go directly if you have your favorite charity. Of course, West Point is everyone's favorite charity as we approach our 50-year class giving, but it can be, when I think of favorite charities, I think of other than family, church and West Point high on that list. The next category, charitable gift annuity, I'd like to just hit the highlights of that. A lot of, as Frank said earlier, the source of funds for that charity could be cash, typically, or it could be an appreciated asset. But typically, the beauty of it is it's the simplicity. There's no cost. When we did ours with the AOG, it was very simple, and we actually combined it with a QCD. There's a recent tax law provision and a well-kept secret where the IRS allows a once-in-a-lifetime QCD transfer to fund a charitable gift annuity. So you might consider that as another strategy, and that there is a limit on that. So whereas, as you can see on the slide, the qualified charitable distribution has ratcheted up to $111,000 limit per year, and that's per taxpayer. So married filing jointly could be double that. There is a limit of $55,000 currently to fund a charitable gift annuity from a QCD. But of course, you could go much higher amounts with other assets or by writing a check. But it is a fixed income stream for life. So you are getting some benefit during your lifetime, and then at death, the long gray line endowment would be the beneficiary. And when you think long gray line endowment, I think of Herbert Hall and the Ring Melt and 50-year class affiliations, memorial services, alumni communications. So the long gray line endowment at the AOG does a lot of great work for us. And the third item up there, charitable remainder trusts, is another vehicle that can be used as kind of a combination. In the name, that the charity does get the remainder of the money that is in the trust, and there's income for life, just as the charitable gift annuity provided. A couple of differences. It is a little more complex. It requires a trust document, and this is one where I think you'd want to have an attorney involved and a financial advisor. It's an irrevocable decision, irrevocable trust. There are a couple of different types of trust. There's a charitable remainder annuity trust that provides a fixed income, and a charitable remainder uni trust, which where the income could fluctuate to the beneficiary based on the underlying assets and investment return in the trust. But a little more complex, but a little more flexibility too. One can benefit other areas at West Point in addition or in lieu of the long gray line fund. So a little more flexibility, and likewise setting up with multiple assets. Where I've seen this used is typically high net worth people with business assets, business stock, using appreciated assets. So it's both a tax strategy and a charitable strategy and an income strategy combined, but a little more complex. And again, just if it fits, it's something that you definitely ought to contact the AOG staff, Vicki, and talk to them as well as your own advisors, and make sure it fits for you. So with that, Frank, I'll turn over the next section here.
Great. Thanks, Michael. So I'll continue the conversation. I've got two other vehicles that we're going to talk about here pretty quickly. The first one is a bequest. And a bequest, I like bequests. They're one of the simplest and most familiar plan gifts, but I also think it's one of the most overlooked. It's a charitable gift that's made through your will or a trust, and it can be structured in many ways depending on the donor's wishes. One may leave a specific dollar amount. You could leave a percentage of your estate, or you could leave a residual gift, like once all other needs are met, and then the remainder could go to the charity. And typically those can be revocable or irrevocable. One reason bequests are popular is that they're very, very straightforward and they're very flexible. They don't affect the donor's current cash flow. They can remain revocable during the life and can be changed if your family circumstances change. If your finances change or your priorities change, then you can always go back and revisit the bequest. This makes them very appealing for donors that want to make a meaningful legacy commitment without giving up control during their lifetime. Another useful point is that bequests can help donors make gifts larger than they might think possible during their life. A person who may not be ready to make a major current gift may still be able to have a substantial charitable impact through an estate plan. Lastly, the one final vehicle I'll talk about is a beneficiary designation. Beneficiary designations can also be very simple to execute, and much like bequests, they're very often overlooked. Many people carefully update their wills, but forget that retirement accounts, life insurance policies, donor advised funds, and even bank accounts may transfer out of their estate according to beneficiary forms rather than through a will. So in order to effect this transfer, a donor can complete a single form, and they can name the charity as either a primary beneficiary, a percentage beneficiary, or a contingent beneficiary. That simplicity makes this, I think, one of the most accessible charitable tools that are offered out there. And you can do this and change it as often as you like without having to revise your entire estate plan. One thing that I find useful when talking to donors about these beneficiary designations is that the donor doesn't necessarily have to choose between family and charity, even if they put a small percentage of that designation towards the charity. That can really create a meaningful legacy over time. An example that I see a lot is where an older retired couple, a widow or widower, they have done very, very well over the years. They've accumulated a decent amount of wealth. In addition to that, they've got a paid up life insurance policy. And that policy was always there. It was meant to provide for emergencies, premature death of a spouse, maybe a chronic illness. And now, upon their demise, they're going to designate their physical assets, their house, their car, their cash, their IRAs, to be split amongst their heirs. And now they've got this life insurance policy that was really just meant to be an emergency policy. So it was kind of like a little bit of, icing on the cake that they have, never intended it to be there when they passed. So they can designate some of that to go to the charity, or they can designate some of that to go to their heirs as well. And then before I turn it over to Michael and then we wrap up for questions, I'd just like to remind folks that last year there were some very meaningful legislative changes that were contained in the One Big Beautiful Bill Act, and that those changes came online in 2026 regarding the tax side of giving. Two quick changes that were embedded in that bill. The first is now the ability for taxpayers that take the standard deduction. And now you can still deduct for charitable contributions. So it's $1,000 for single filers and $2,000 for those married filing jointly. And secondly, there were changes for those that itemized, and it makes planning even more nuanced now because of the changes in the bill. The law introduced a 0.5% floor for charitable deductions beginning in 26, and then certain higher income taxpayers, they may see additional limits on deduction value. So all that means is that the timing of the gifts and the type of assets that you use may matter now more than they did before. So I just think that's another reason to stay close to Vicki and her team at AOG. And if you have any questions, reach out to them or your tax advisor if those are some things that you're considering. And I'll turn it back one more time, back to Michael.
Yeah, this next section, creating a charitable legacy, is probably one that books have been written on. But I just wanted to give you a couple of quick thoughts and talk about some of these summary tools that Vicki and Frank have introduced as well. And first, just it's a little intimidating to use the word charitable legacy, I think. And for those of us who don't consider ourselves high income or high net worth, that can be a little intimidating. So the first point I would make is that everyone can be a philanthropist and do something. And I think it becomes part of your life of purpose, life of significance, and part of that is certainly being a role model for the next generation. And I've talked to a number of people that say their families don't miss the money that might go elsewhere, and they're very proud of the donor. So think about that. But in terms of setting up gifts based on priorities, I'd like to give you a couple of examples that summarize the use of some of the specific tools. One of them, if your priority is current impact, we talk about cash gifts and appreciated securities. A number of years ago, my wife and I did a combination of a cash gift and some appreciated securities that my mother had left me, and they had appreciated over a period of time. And we set up a Colbert Family Scholarship in memory of my father and my uncle, and in honor of our son, all of whom had gone to a little private school in Massachusetts. So we were proud to do that, and again, we used the appreciated securities technique, so it was a very simple thing to set up. You know, and another, I mentioned earlier, using qualified charitable distributions. We've done that both for reunion gifts, the AOG, and as I say, we did create a charitable gift annuity as well at the AOG with the use of a QCD transfer, which was, again, extremely simple. And that, again, is a combination gift of charity and then income and cash flow. Frank had talked about beneficiary designations. We've used charities as partial beneficiaries for future gifts. Of course, that's a revocable deal, so the charities have to be nice. But I think that's a great use of IRA money because quite frankly, our son would rather be the beneficiary of a tax-free insurance policy versus a taxable IRA distribution. So beneficiary designations or bequests are certainly tools as far as leaving future legacies. And Frank talked about donor advised fund to lower current income tax. I see some people like to consider consolidating their gifts into a one-year donor advised fund, so they might itemize for 1 year. You know, the standard deduction now is so high that a lot of us moderate income folks are very happy with the standard deduction and the, you know, $2,000 deductible charitable contribution. But certainly a donor advised fund can be a way to consolidate gifting. And as Frank pointed out, you know, you're deferring the decision on where that money gets distributed. So it sits in a donor advised fund and is distributed over time. So that's another great tool. But finally, I would just say, you know, and even a donor advised fund in our case, you know, we look at it'll have a final beneficiary designation, and I'm sure the Association of Graduates will be the beneficiary after my son gets through as a successor custodian on that. But again, to us, the Margin of Excellence programs at West Point make a big difference for cadets that I think makes them better people. And when I think of gifting, I also think of faculty and staff at West Point. I think of classmates. I think of roommates. So I think of people more than I do the institution. And finally, I would just say, you know, part of the legacy discussion should include thinking about a non-financial action that everyone can take, and that might be sharing a letter with loved ones, a letter that they'll get after you're gone, but just talk about your values and tell people you love them, you're proud of them, stories, blessings, and guidance. Thanks.
Thank you, Michael and Frank. Really, we appreciate you doing this for us, and it means a lot. So I'm going to give a few closing thoughts. And then just a reminder, if you have any questions, please put them in the chat. We did receive a few questions earlier, so we'll start that. But just in closing, just remember the best charitable plans are not necessarily the most complicated. Often they begin with just a few simple questions. So ask yourself when you're ready to start thinking of this, which causes matter most to me? Which assets am I best positioned to give? Do I want to make an impact now, later, or both? Would I benefit from income while supporting charity? What legacy do I want to leave? When you answer these questions, you are identifying giving strategies that allow you to support the causes you care about in ways that are thoughtful, tax efficient, and aligned with your personal goals. So just remember that as you're thinking through this, that it's a thoughtful gift, tax efficient is always good, and that they're aligned with your goals. The ultimate goal of planned giving is not simply to save taxes. There's so much more behind it. That legacy, leaving something to places you truly love and helped form who you are as a person. It is to use your resources intentionally so that your values continue making a difference for years to come. So in closing, first of all, again, thank you, Michael and Frank. But Laura, I'm going to hand this over to you. Laura Cruz is our planned giving officer at the West Point Association of Graduates, and she is going to ask questions, and Michael and Frank are going to answer those. So here we go.
Yeah. Thank you all so much for coming this evening, and I appreciate both Frank and Michael for participating and giving us all this great, useful information. So I'd actually just like to start, please, just as a reminder, if there's any questions, you can add them to the chat. We did receive a few questions prior to as part of the registration process, so I wanted to start with those. This one is kind of a hybrid of a question related to qualified charitable distribution and the itemizing of deductions. So I'm going to hand it over, I think, to you, Frank, because you had talked a little bit about the tax consequences. Can you just tell a little bit about how somebody could determine what's better to make in terms of any particular year, whether you should be looking at using a QCD versus itemizing deductions and giving a gift that would allow for that? And what factors you would sort of look at to make that determination?
Yeah, I think the way I kind of split it in my mind is the QCD distributions or designations typically skew to the older population, folks that are closer to retirement. The other higher appreciated assets that you would normally give if you want to itemize in your deductions. That's usually, as I mentioned earlier in the conversation, typically that's the most effective when you're in your peak earning years, or let's say you're in a situation where you get commissions or you get a bonus. So you might have a year that's an outlier where you get a significant increase in your income. So that would be the year that I would look towards moving your charitable contributions to something like a donor advised fund in that year to take advantage of the itemization. I think that's how I would perceive it. I don't know if Michael has a different view on that.
Yeah, Frank, I would agree with you. My bias would say probably QCD, but I would also advise that you put your tax advisor to work and run the scenarios and see what, if any, benefit it would be to itemize deductions and make a higher contribution out of pocket. But I would tend to think it could be a combination thereof as well, not necessarily an either or.
Correct.
Thank you both. And just to put a little plug in for ourselves here, if you are interested in learning more about a particular tool and how it might affect, your taxes, or to look at an illustration, that is something that actually our team can do for you. We can't say that the illustrations are an exact, panning out of how everything's going to turn out. You do need to talk to your financial advisor or your attorney, but this is an opportunity for you to kind of get a general picture of how things might be different if you give one way versus another. And it's a very valuable tool. So we're happy to do that for you if that's something you're interested in. The second question I have is, can the full amount of an RMD go as a QCD, or is there a maximum limit set?
Yeah, again, there is a maximum, but again, to reach the maximum, normally an RMD, you're talking, 4, 5, 6%. So if you had, $2 million in your RMD, you're not coming close to the QCD max of 111,000 for this year. And that's indexed for inflation. So that 111 number will likely go up. So I would say normally you're not going to have to worry about it.
Thank you. And the third question I have, and this one might actually, Vicky, you might want to chime in a little bit on this, is just to kind of explain the difference between a charitable gift annuity and a charitable remainder trust a little, some of the nuances between those two vehicles.
Sure. The nuances as it pertains to the Association of Graduates, I think Michael and Frank are kind of explained what they are and what that looks like. But the nuances as it pertains to the Association of Graduates, your charitable gift annuity will automatically, the designation is a long gray line endowment. And the reason behind that is the Association of Graduates takes on the liability of paying out that charitable gift annuity until the end. So in an instance where, let's say, the CGA runs out of money, the Association of Graduates will still pay for that. Now, fortunately, that really does not happen too often, so we're fortunate with that. But since we take on that liability, that is definitely designated to the long gray line endowment. It's a much easier process to do. You can contact us. We can run, as Laura mentioned, illustrations. We'll share that with you. Everything is done through our financial institution we use, which is BNY Wealth. So we work through that. The whole process takes a very short time frame. Whereas with the charitable remainder trust, whether it be a uni trust or an annuity trust, those require you to have an attorney write up that trust document. So it's not just a simple run my illustration, here's my check, and so forth. You have to work with your attorney to make that happen. The nice thing about those, they can be designated anywhere. So if you prefer to give to the Soups endowment, or you loved when you studied German and you want to give to Dual to the German department. I mean, there's different ways you can give that way, but that's the main difference and nuance as it pertains to the Association of Graduates. Frank, Michael, do you want to share anything else on it or no?
Well, yeah, if I could, I'll also give AOG a plug and recommend that the participants on the call tonight request of you, Vicki, to send out this beautiful booklet, Changes Affecting Estate and Gift Planning, that the AOG has. And there are a lot of good tax tables and information on Medicare and some of the charitable gift tools that we've talked about tonight.
I will do that. I'll go back on Monday when we're in the office, and everyone who is on this call or signed up for it, we will mail you a copy of that brochure. Perfect.
Thank you so much. I think I have one more, and I think this is actually sort of a great way to top the night here. Just to be clear, we will definitely get back to you with any other questions that people had that we're not able to get to this evening. And if you want to ask questions afterwards, we can reach out to you. You can email us. We can set up a call. But I really like this question just because I think it kind of goes to what are the next steps? What should I do after today's webinar? What would be helpful?
I mean, I think when we talked at the outset, Laura, I think it's, once you figure out what your goal is, and then you figure out what's the best thing for your family, I think reaching out to Vicki and her team and letting them know that this is what my plan is, this is my goal is, this is my intent. How should I proceed next within AOG? And then once you get that information within AOG, depending on how complicated the situation is, you may have to go back and speak with your financial advisor or your lawyer if that requires it, or it may be something on the simple end that we talked about earlier, like a beneficiary designation or a donor advised fund that may not require such outside scrutiny. So I think the best thing is talk amongst your family, figure out how generous you want to be and what you want to accomplish, and that's when you should engage Vicki and her team to see next steps.
And I would add, I think it's a process. So you're in charge, and do what you want to do. It's your money and it's your life, and I think the steps of self-reflection are good, but I think the process of estate planning is lifelong, and so you've got your whole life in front of you, the rest of your life, and so I would just take it a step at a time, and There might be a strategy you can do this year and a strategy you do 5 years from now or 10 years from now. But talk to your family and take charge.
I'm going to agree with that. I think talking to your family and really understanding what philanthropy means to you and what that is. You might be able to do something now, but you can also do something later. And I think the big piece is just realizing the difference between the gift vehicles that are revocable versus irrevocable. Because if you want to do something irrevocable, you can't change that. So really think through, if you think there might be a need to change something down the road, look at those revocable opportunities instead of the irrevocable ones. I think that's kind of will help you decide as well. All righty. Well, I think we are done. So I just want to, first of all, thank everyone for joining us, sending in your questions, being a part of this evening. Plan giving, I think it's fun. I hope everyone else does. So, and I can't thank, first of all, Danielle and Laura, who work in the plan giving department alongside me. Great people, great staff. 3 of us are here to answer any questions you have. Michael and Frank, I don't even know where to begin to say thank you, but it's great having you on this webinar, but also a phone call away anytime we have questions, and for helping guide and mentor us as members of our plan giving ad hoc committees.